I'm very happy to welcome every one of you to today's masterclass. It will be the last one in this year half, which honestly ends in 3 or 4 days. I do understand that we might not have too many attendees today because most part of our audience is credit managers, and credit managers are extremely busy these days because they are finishing their quarter and finishing their year half. So I wish everyone who is doing difficult credit management job at this exact moment in the office, and I hope you will watch the record of this masterclass afterwards. My name is Andrei Sichka. You might know me under the title or term creditologist. It's discussable and debatable whether or not this is the correct term, but this is the simplest way to explain what I'm doing. I am a person who is studying, who is discovering, who is researching, who is educating credit management. Therefore, the term is creditologist. I didn't create this term myself. I just found it and just, decided that this would be appropriate. Why? Actually, there are two things why I allow myself to speak about credit management, but before I share them with you, I would need to make an important reservation so you won't leave today's event with the mixture of things in your hand. First of all, and most important, is that everything I will be speaking about today is dedicated to what we call trade credit. So if you are working in financial services, in B2C, or what we call consumer credit, this might have relevance, but this is not complete truth for in these specific areas, like when we speak about loan portfolios or investment or something of that. Everything I'm speaking about, and this is my main direction of expertise, is a B2B trade credit management, where companies extend payment terms to each other, either on sales side or on purchase side as well, because this is like the same thing reflected in the mirror. There are, again, as I promised, two things which allow me to say about this, to say a word about this important topic like credit lending. Well, I was lucky enough to to recommend lots of, thousands of different trade credit decisions, and some of them I took myself, some of them I recommended, but out of all of that, over 14 years managing quite big and small trade credit portfolios, I managed to write off very tiny amount of bad debts. Specifically, that was like $8,000, quite small. I admit that most part of that belongs not to my knowledge, not to my professional expertise, but to my good luck. There was somebody, I don't know where, who was actually helping me to achieve this result. On the other hand, in my consulting career, my training career allowed me to look at this result critically and try to understand what helped me to do that, with except for only my good luck. Was it really a good luck or something of that? So I managed to transform that experience. And at the same time, being in my corporate career again, I achieved that result with the help, and this help maybe came despite the fact that I did lots, I would say enormous amount of credit management mistakes. And despite that, I managed to achieve that result. So I allow myself to do that because like not really as a pride, but mainly as a confession. To give you a practical example, if you can imagine yourself standing in front of the CFO and trying to explain how could the company have an overdue with the client whose official contractual terms are cash in advance, but you have an overdue. So you can imagine how many mistakes I did. But, I mean, to a certain extent, specifically number of mistakes made makes people experts. So therefore, I mean, if somebody will call me expert, I would not mind, because I made lots of mistakes in credit management. The reason for today's masterclass and the name and the topic is actually credit limit reality, because over my career I was reading lots of approaches how to establish credit limit, and I'm doing credit management. I am in credit management for nearly 3 decades, very close to 3 decades, and sometimes I read lots of wise advices and wise things about that. And very often, especially now, I read on LinkedIn, lots of materials about trade credit, and sometimes what I'm reading about credit limits, about approaches to establish credit limits in trade credit really makes me embarrassed and upset. So the reason for me today is, the main reason for today's masterclass, my intrinsic reason, is to share with those who found a minute or a second to stop and think a little bit what we are doing, and try to save these people a little bit of time, a little bit of their energy, and a little bit of money to their companies. Because what I can tell you, and I will try to illustrate that a little bit, the world of trade credit, and let's call it trade credit industry, is full of stereotypes and misconceptions. And they are, all these people continue to exercise, to apply these misconceptions to their business, and they continue to justify, mistakes with the principle which exists 180 years, if Glenn Bullivant is not cheating me, that, DSO exists 180 years or something like that. So that's more or less one of the biggest misconceptions. But today we will be speaking. Today we are speaking about credit limit and all the misconceptions related to it, because number of misconceptions and stereotypes in trade credit is really enormous. By the way, if you are interested to dig into that, put something in comments so I know you are interested, and I got an idea to organize a masterclass specifically dedicated to all possible misconceptions. So if you know any of them or you would like to discover, put that into the comments, and we will consider them in one of the masterclasses, I hope still this year. And let's get to the first and most important misconception related to credit limit. Yes, it is written like it is. Receivable is a loan. I read lots of articles, and many of them were quite wisely written with I could not say they are wrong. You see, on the first attempt, if you say a word credit, you will easily catch that credit is related and has a connotation with the banking system. Ask yourself, if you say the word credit, first thing which rises or your mind generates would be the bank. But credit is much more wider than banking system. Credit, or an element of credit, exists in every possible business transaction. And loan, either corporate loan or consumer loan, whatever, is just one particular case of credit granting. It's quite easy to see that receivable is type of credit. Then payable is actually receivable and in different, reflected in the mirror. Every employee who is going every working day to the office is actually a creditor to a company, and there are receivables. We start working on day 1st of the month and receive our salary on 20th, so we provide credit. I mean, it's not possible to do business without providing credit, but should we simply extend the principles we used to manage loans or loan portfolio to every possible credit? It's an open question. To my personal understanding, due to many different reasons, but receivable, loan is a specific type of credit, and the main differentiation of loan from other types of credit is quite simple. Loan is a product itself, and receivable is not. Receivable does not have any, normally receivable has no interest rate. Receivable is not selling because it is not a product itself. Therefore, there are many other reasons, but this is the main one. Receivable is not a product, it's an additional service which helps to sell the company's product. Therefore, receivable is not a loan, and unfortunately, we could not manage receivables portfolio in exactly the same way as banking system manages its loan portfolio, despite the fact that lots of credit developments in the areas of credit risk, in the areas of methodology of credit management and loan management. It is very, very developed environment, very nicely regulated environment, but when we go to the world of trade credit, to the receivables management, we could not apply all these principles directly as they are. I spoke with many people, with many experienced people, much more experienced than I am. And I was asking all of them whether or not we can simply take, because some of them did to both careers. They started career in a bank, or they were working in a bank, then they moved to trade credit. Some of them were moving back and forth several times, but they reconfirmed that. And my personal experience, I came to trade credit from the bank and tried to apply everything I've learned in the bank directly, and I found it doesn't work. It doesn't work. The main explanation for that is, you see, in banking system, we normally stand in the position of excluding credit, because excluding means that we can exclude customers we don't like or we find appropriate from our portfolio with the credit policy. On the trade credit side, normally, there might be exceptions for both rules. We are using credit to attract customers because we are living in the competitive environment. And the problem, which is actually what says us, what connects us with the credit line, bank, or any creditor which is living in an exclusive credit position, they set a credit limit on the level they want, on the level of risk they want. In the inclusive credit, where we are competing, where we are attracting customers, it's not already a question how much risk we would like to take or we are happy to take. Then the question how much risk we need to take in order to make this transaction happen. And these are two absolutely different stories. In banking system, risk assessment could be a ready-made decision. We assess risk, we understand that, okay, we will work with this customer, we will not work with this customer, something like that. The same story for the credit limit, because we are allowed to say no to a customer with no consequences to our business, which is not the case in a trade credit. In case of trade credit, we need to think twice before we say yes, and we need to think 10 times, if not 15 times, before we say no to a customer. Because idea of trade credit is to move our products or our company's products along the trade channels to the final consumer. And if we say no, we are cutting ourselves, we are cutting our business. I mean, if it is unclear, please put that in comments. I will be happy to explain this once again, 3 times, 10 times. But this is the main differentiation. I just want you to simply take, unless you are in exclusive credit position, you cannot simply take banking practices directly to trade credit. This will not work. There are thousands of examples when the companies are setting up limits exactly as it is, provided or explained in, for instance, in Basel Accord. Then they understand that these limits are not enough and we need to sell. So we need to do something because we are in competitive environment. These are 2 different worlds, unfortunately. So, when we speak about credit limit itself, we need to just think a little bit. I invite you for that common thinking. Thank you, Michael. Thank you. I'm very happy we are on the same page. You see, first of all, let us understand, because we need to define the terms. Yeah, let's call it philosophically, ontology. What is the credit limit? What limit means what the word limit means actually. Limit means there is nothing above. So we are limiting somehow the maximum amount of accounts receivable we could have with this or that specific customer. I would like for now to abstract from the specific role we play within the company. And if you really want to manage credit successfully, my suggestion would be to look at the situation not with the eyes of your own role, but with the eyes of the business itself as a whole. We as a company, Yeah, then let's ask us a question. Why do we, what is the credit limit? So we are limited the maximum amount of accounts receivable we could possibly have with this or that specific client. Yeah, why do we do that? Most of you, would rightly say that this way we are limiting the risk we are happy to take with this or that specific client. Then there will be a question: should we limit an the balance outstanding with the customer of high credit worthiness, or with the customer where we virtually have no risk, like state monopoly? I had, in my corporate career, I had a couple of examples where, there is a state monopoly of in the developed country, quite developed country, honestly. So, should we limit our sales, because we understand, and our sales colleagues who are calling credit managers, with all these nice words? My favorite one is sales prevention officer. Should we necessarily put a limit to every customer? I don't say there is a direct, the one only answer. And I have to apologize, because I wanted to do that in the beginning. I have to apologize to all of you who came to this masterclass for formula or for the recipe how to set credit limit in each and every specific situation. There is no one single formula, unfortunately. And I called that masterclass Credit Limit Reality just because of that. Because there is no one single formula. My apologies for that, but I have to disappoint you. And honestly, everyone who will telling you that there is a limit, they know that's one of the reasons, because I started to read that increasing number of articles, videos saying our credit limits are most precise ones. That was exactly the moment where I started to prepare this masterclass. Thanks to my current last two publications, I've read another publication of the same author, and they already changed their opinion, so I'm very happy. I'm very happy because there is less misleading materials on social media. So that's one of the ideas. On the other side, another extreme example of use of the credit limit. We set a credit limit, but then the sales order, the new order from the customer is coming which does not fit. And then we sit, we discuss, and then we increase this credit limit once again. That's already very good. Yeah, because the order simply didn't go through without our control. But at the same time, if this happens over and over and over again, each time the sales order doesn't fit the credit limit, we increase limit, then it's a question, do we really have a credit limit? Yeah? If this happens to you, I've read that in comments of my commenters under my post, that this is what happened. So, like literally, companies take credit limit from the credit report agency, they put that into the system, then the order is coming, and they find that this credit limit is not enough, and they simply increase credit limit. Then, do we really have a credit limit? Do we really have a credit limit? And but that's like for us to ponder, to consider different possible situations, mainly for our credit policy. by the way, again, credit policy, whether or not we have right policy, wrong credit policy, and whether or not the policy we have is really working. It's a question to ask to credit managers whether or not we are doing the right job. And finally, can we calculate a credit limit? Because we all believe, so if the limit is a number, there is nothing above that number. Since this is the number, then there will be a question, can we calculate this number, and whether or not credit limit could derive from a formula. I share with you on the slide the clash, actually, of the two main approaches, or two extreme approaches, which we in our activity face when it comes down to credit limit. There is one extreme approach on the left, which is in green one, and if you ask sales, for example, or marketing, or sometimes even general manager, what should be a credit limit? They would say that this is something which is supposed to derive from the future sales and terms, either future or current ones. Like, I don't know, sales focus multiplied by DSO, or by payment term. Equivalent, or the payment terms, DSO equivalent. I do believe you know how to calculate that. I don't want to annoy you with that math. On the other side, there is another approach which says that a credit limit is to derive from the financial stance of our counterparty, that is customer, supplier, or whoever. Then we need to ask ourselves, which of these approaches is wrong? Yeah? I mean, the right one is more or less what we got with credit reports. The right one, which is coming from our credit analysts, and from many other financial side of the story. And you see as you can see, the arrow sign contradiction, they are clashing, because there is a view from financial side of the story, and there is a view from the sales side of the story. Intuitively, you can see, and it is, yes, obviously, I was preparing myself, so it looks like I prepared that, I did that for the purpose, but you can see that intuitively you can feel that these are two parts of the same thing. So, both approaches are correct, but the problem, and at the same time they both are wrong, because neither of that could be a credit limit. To discover you, and actually to take you closer to the end without annoying, I can tell you that we could not simply calculate credit limit, because formula we use, we can put a formula, but this will be our decision. But assuming we have no credit policy, because credit policy is deriving from our experience and our current situation with customers, and deriving from our experiences of setting up credit limits and credit terms. But the formula could not take the responsibility. Whatever formula we take from agency about the customer's credit assessment or financial stance, and I can give you I can give you like several, lots of angles of views that neither assessment of credit worthiness or like assessment of credit limit, as it is drawn here, is correct. Main thing, because we are applying that credit limit to a future, and most part of credit assessment is based on the past, on financial statements and things like that. The other side, can we simply apply any credit limit disregarding financial stance of the customer? Can we disregard credit risk? No, this won't be wise. This won't be wise as well. So, one side is that, yes, we need to take into account financial stance of our client. We need to take into account the future sales and our plans. So, generally speaking, we need to take into account, on one hand, how much credit is needed to complete a transaction, to make a sale happen. So there is a need, and then how much is safe. So we need to know how much is safe. So we need to know these two extremes. But whether or not either of them is able to define the credit limit, extreme, yes, but the final solution would never be a calculation. The final solution is how much credit we will give to customer or a supplier, to our counterpart. We will give, because there is a free will of a creditor, and take the responsibility of that. Now, some of you who follows me for quite a long time, I was asking a question whether or not there is a legislation which I did a bit of research to clarify whether or not there is a piece of legislation in any country on the globe which imposes which requires a creditor to provide a credit to a counterpart, and I failed to find one. So it's only every credit given on this planet by any business to another business happens due to free will of a creditor. So the credit limit is not a reflection of how much is needed and how much is safe. These are two influencing part of that. I will show how to use them in the future. But in the end of the day, credit limit is a reflection of how much credit we will provide or we will grant to a customer. And this is always a management decision. So credit limit is not a formula. Credit limit is not a calculation. Credit limit is a will. Is a decision taken by somebody authorized or by the company itself. Whoever personally does that. So how can we change that, and how can we take it? So it's quite simple. We need to have a look. We can change the situation. And by the way, this, what you can see on the slide, this clash, is one of the main problems of credit management, which creates a conflict between sales and finance, or a sales credit conflict, famous one. But we can easily change it. To do that, we simply need to call a spade a spade. Approach based on the future sales and terms is not a credit limit. It's a top line, or let's say is the higher extremum, normally higher extremum, which we called credit demand. So how much credit is needed to grant for the transaction to happen. At the same time, equally important is a credit worthiness. So how much credit we can grant to this or that counterpart staying safe without any additional security. And if you look at the arrows on the slide, you can see that we don't need to look from the functional perspective only. We need to look at the situation altogether. I did that many times with my sales colleagues. It works perfectly. We put all the numbers, both numbers, on the slide or on the table, and then look at them together and take a common decision. Sometimes we involve management, or we put that in front of the management. However, the main idea, we look at both components of credit decision, risk and opportunity, if you wish. It's a classical approach. And then decide how much credit we will give to a client. Or maybe to a supplier, to a counterpart, whom we have to provide credit in order for transaction to happen. We don't need to forget that every calculation of credit demand will involve a payment term. Those of you who attended the masterclass dedicated to payment term, that was the last one, I just recorded that slide. I like it, and as you can see, that green line is quite wide because there are always adjustments to that. But you see, payment term should be aligned with the credit limit, because if the payment term is too long and the credit limit is too low, this payment term will never be used by a client. Client will never enjoy it because they will be restricted by the credit limit, and vice versa. If the credit limit is high but the payment term is short, this will never work. So please make sure in your operations that the credit limit and payment term are aligned between each other. So what can we do? What can we do with the credit limit? Obviously, one of the tricky things here is that we need to reflect both. We need to reflect both elements of credit limit approach, if you wish, in the same units of measure. Yeah, because if there is a credit demand in money and then credit worthiness as default probability, which is percent, it would be quite difficult to compare pear and apple. We need apples and apples. Therefore, credit worthiness is to be reflected in money. But this is main trick. When we compare the two, when we reflect this becomes extremely easy to view the situation in general and to take a decision, because we compare money and money. How much money, the difference between the two, between the credit demand and the credit worthiness, actually constitutes risk. What you can see on the slide is an exceptional case when the credit worthiness is extremely higher than the credit demand, and here the decision is obvious. Yeah, there is a credit demand of, say, 600,000, and then there is a credit worthiness of 1 million. Is that difficult? Is there any difficulty to put a credit limit? Of course, we don't need credit limit significantly higher than it is needed. 600,000 is enough, and the decision is obvious. In my practice, there was a case like there was a need to change a credit limit from $5 million to $25 million. We assessed credit worthiness quite quickly, and we understood that the client has $1 billion credit worthiness. With all due respect, I asked my boss, please, why don't we increase the credit line to 50 million? Why don't they purchase from us more? Because they are credit worthy, and this is the safe sale. Quite easy, but this is exceptional case. Unfortunately, in many other cases, we have a situation which is opposite, where the credit worthiness is below the credit demand. So, customer's credit worthiness is 600,000 and the credit demand is 1 million. Then we need to recall 5 ways to manage credit risk. And if you look at this slide, you can see that now credit risk becomes visible. You can clearly see that, okay, this is relative. Every risk assessment is relative, but in this case, this becomes visible. Much more visible if you compare the $1 million of credit limit requested with the default probability of 5% or 10% or 15%. Do you feel any difference? I say feel. Then, but here we can see that the credit risk is 400,000. Then we can compare that with the profitability, with other benefits we receive from this transaction or whatever, but it is visible, it is feelable, and every function within the business can understand that credit risk now. Everybody, from cleaning lady to HR and to general management, we can make it visible. And then we put credit limit. In this case, we reject risk. Yeah? Because we set credit limit, we propose to set credit limit on the level of credit worthiness. If the credit worthiness will be 0, this will be cash in advance. Not necessarily, but could be the case. Yeah? Then there is other extreme. Because rejection of risk is one of the way to manage risk. Another way to manage risk is risk acceptance. So we can accept credit risk. In this case, we take much more commercial decision and we put credit limit on top of that. Could be even higher if we wish, but then we need to understand that we are taking more risk. Nothing prevents us from taking risk. We're supposed not to shy away from risk because we are supporting our sales and our company's growth with credit. Again, we know that there might be a cost for that. Yeah, because we are taking risk. But we can, the purpose of today's masterclass is not to consider all the possible ways, but there is another way to do that. The third one, the most common one, we can use trade credit security. And we can add additional protection, so the credit limit will stay the same. It will be high, so we take risk, but we cover our risk with trade credit security. We don't cover, honestly. We are not removing credit risk. Let's not forget about that, because we are transferring credit risk to a third party at a fee. Then we need to consider the credit worthiness of that third party, because otherwise, if we have one bankrupt and then we have a guarantor of that bankrupt, which is also a company in a technical bankruptcy situation, this means that we are not changing anything in the credit risk composition of our transaction. So we need to assess it. But then, if this risk is lower, meaning that credit worthiness is higher, this is one of the solutions. Here there is an important thing to discuss, because very often companies, how to say that diplomatically, exercise over-reliance on the third-party providers, like setting up credit limits as it is given by trade credit security provider, like credit insurance or the bank guarantee or something. You see, if a company is in that exclusive credit situation, this is absolutely appropriate. So, meaning that you got a queue of customers who are happy to buy you and you can choose between them. Then, if you still decide to grant them credit, because being on that side, being on that situation, I'd prefer to simply, avoid granting any credit granted, simply cash in advance and go ahead. This happens in some markets. Don't believe this is impossible. This is possible, maybe not for a long period of time, but this could be the case. So if you are able to dictate terms of credit, if you are in exclusive credit situation, and if you are and if you decided to grant credit, as I said, and you put provision of trade credit security as a condition of credit granting, then that's okay. And if one of the customers is not able to issue a bank guarantee but another one is able, then you simply transfer yourselves from one customer to another and you have no issue of finding another client. That's okay. But if you are in a competitive environment where importance of customer is extremely high, then you need to think twice before you outsource. Let's put it this way, outsource your right to a trade credit security provider like credit insurance company. Credit insurers do good job, but do you believe they should be allowed to take your own credit decision or your creditor's will and take your credit decisions? It's question to you. It's question to your own situation. Every company has its own set of factors around, in the business environment. There is no straight answer, but just think about that. Whether or not the limits or amount of credit decided by a third party would be enough for your business. That's everything I wanted. So be careful with that, because in this case you are giving your free will of a creditor to a third party. And one important thing about, I would say, every security provider with no exception, you as a creditor, you as a company who is selling goods and services, are interested in more sales. And this is one vector, one direction, one wheel. And when we speak about security provider, yes, they are interested in more sales, in higher volumes. But first of all, their first interest is risk. They want to take less risk with a higher volume. So these two directions not necessarily corresponding. So be careful before you delegate your decision-making authority, your decision-making will to a third party. I don't say something possible or impossible. In very, very general terms, I must say that the only, if there is an ultimate truth about credit limit, or in general, if there is the only one ultimate truth about the credit terms in general, is that every single couple or combination of buyer and seller requires its own very specific, very individual, unique set of credit terms. Normally they include payment term, they include credit limit, they include security requirement, but they might also include discounts, other terms like delivery, others. So most correct answer, most correct phrase would be that this commercial setup will always be individual. So just take care of that. Just take care of that. And be sure that you are setting up the credit limit and other credit terms. Another important thing to mention, that there is no right or wrong credit limit. Credit limit could be either adequate or not. So in this sense, being right or wrong, or the measurement of correctness is appropriateness to a specific transaction. In the masterclasses, each time we are speaking about trade credit structuring, I always say that the good setup of credit terms, the good set of credit terms is the one silent. So, generally speaking, in terms of ideology, I do believe that the credit management is to generate silence when customers simply buy from us, pay on time, and order again. And this spins, this cycle spins, this flywheel spins with the highest possible speed, generating cash for both sides, generating profits for both sides. That's what's supposed to happen. Obviously, there might be people who like, solve issues every 15 minutes. This could be the case. Adequacy or optimality of credit limit, we might find one. I mean, there is a corridor, having experience, having knowledge. We might find optimal limit, but the problem, and you intuitively might feel it, that neither credit limit will be adequate forever. What you can see on the slide, I like this because this is Mobilis in Mobile. It's a motto of Nautilus, of Captain Nemo. It was his motto, Mobilis in Mobile, like moving in the moving environment. And as you can see, the credit worthiness could be stable because that's more or less an assessment, but normally it deviates. Trade credit security could deviate the same as well, but the main issue is that credit demand is changing constantly. And if you see that orange arrow, this orange arrow symbolizes today. So when we look at credit demand into the future, we understand that in some future time, our credit limit would lose, and our our credit terms in general would lose one day their adequacy. As you can, these are like 5 months in advance. You can see that month number 1 we are okay, then we see that the credit limit is already too high, but starting from month 4, our credit limit will be already inadequate. To share with you like one personal example, quite often I used to receive calls from my sales colleagues who are saying, Ray, we got an order, but we don't have enough credit limit, and the order was already placed, and the truck is already on the warehouse. What can we do? And one day I started to say, like, okay, guys, if you are calling me when the truck is already on the warehouse, we already have a problem. It's already too late. Yeah, we need to think about adequacy of our credit limit much more in advance when we look at our sales projections. So when we got changes in our sales, or like when we are purchasing, this could be the same situation. We place, we place an order, but we could not receive because supplier didn't put enough credit limit on us. So the idea, we need to anticipate, we need to look forward. And then foresee the potential futures with potential issues with our orders, with orders, with credit limit, with everything, and then decide what to do. Again, there will be no obvious answer. There will be not necessarily this obvious answer would exist, but when we anticipate issues in the future, we have time to solve them in the normal professional manner, considering the situation from different sides, because otherwise we will have that. I was describing that because I had, in the very beginning of my trade credit career, I had enough of that. When the truck arrived to our warehouse, the warehouse operator places an order, the order is blocked due to the credit limit issue, and then we start solving an issue. We're calling each other, the truck driver is smoking and going around our warehouse and his own truck and saying and explains his attitude to the situation in non-uncertain words. If you like it, well, you got all the possibilities to do that, but to me there is much more better way to do that, much more friendly. Again, the ideology is smooth operation, when we simply cooperate between the two parties, and we as credit managers are those to organize that, to set credit limit which will silently work, helping both parties to generate sales, to generate cash, and to generate profits. This is nearly everything. This is everything I wanted to share with you today, and I hope you have questions. If any, please put them in the comments. I will be more than happy to answer whatever they are. Michael, it's always an honor having you on a masterclass. Thank you very much for coming. So, ladies and gentlemen who, due to my mistake, don't know, today we had a living legend of credit management, Michael Dennis, and I always feel honored when Michael is coming and joining us. Michael, once again, thank you very much. Nisha, thank you very much. Thank you for coming. I'm really grateful you found time to join us, as again, knowing that this was the busy time for credit managers. Maybe while we are all together here again on Udemy, and on Udemy, if you are interested to look at trade credit structuring in more detail, there is a course on Udemy which is called specifically dedicated to that. So you can Marianne, thank you very much for coming. So you can find that. This is the combination of lectures dedicated to trade credit structuring. So it's structuring and decisions. Put two words, trade credit on Udemy, and you will find one. Again, if you have questions about trade credit structuring, approaches, policies, whatever, give me a call. I will be happy to find an answer for you. And as I already asked in the very beginning, if I really need to know if you wish to have a masterclass or to attend masterclass considering credit management misconceptions. Christian, muchas gracias. I really happy. I really happy to see you together with us. Cecily, thank you very much. We still have a bit of time, so if you wish to ask questions, please don't hesitate. Okay, Nisha already says that she needs a class on misconceptions. Yes. Okay, I think we will. What we will do with misconceptions, I know that most part of the people who are coming to masterclass are reading my posts, so I will put a poll on the different pages. I will put a poll, and so you can vote, and then we will decide by the majority. And Nisha, there is another question. One of my challenges is trying to get the debtor to feel he is entitled to credit. Well, you see, if this is a question, I will say that in general, but only if he is worthy. So I will try to answer. Your question because it's quite interesting. So one of my challenges is trying to get the debtor to feel he is entitled to credit. So if I understand correctly, this means that customers are taking credit as granted with all the tautology. I could say, then you see, on one side, the simplest way to make them feel entitled, to make them cherish the credit granted to them, is to show how this could be if there will be no credit, because credit is trust. And but this could be sometimes drastic if it is a big customer, and if it is an important customer, you cannot simply stop delivering to them or simply cancel credit limit, because this will be too much. This will be like overreaction. Therefore, but at the same time, if you got a feeling, again, this is normally a feeling based on my experience, that your clients do not cherish, do not appreciate the credit they've given, you need to speak more with them. And because normally that unappreciation looks like late payments or payment delays, but here it is a tricky point. You see, the payment delay could happen due to many different reasons. And as I understand your next question, that he feels that he entitled, however the risk is too high. We would need to get back to the beginning of our masterclass. Acceptance of credit risk is one of the way of managing it. So therefore, yes, we might take a high risk, and we might provide customers with quite high amount of credit, although their financial stance is not very good. We are in trade credit. The question would be, how do we manage that? Yeah. So, like, if we provide credit to a customer who is high risk, but this customer is paying on time and they are doing job with us, what do we expect from them? They simply fulfilling their contractual obligation. Again, what here we would need to think. You're asking right important question, but here we would need to think, what sort of appreciation would we expect? What would we consider as the right or wrong appreciation? Yeah, because granting credit is a normal part of doing business. It's not a personal favor. We are granting credit not because we want. Yeah, because if we as a company would consider this thing seriously, we would never grant credit, but we have to. Yeah, it's a question of relationship management, to simplify my answer. It's a question of relationship management, how we manage relations with the customer. And why we increase, decrease credit line, what is behind that? There is no one answer to that. Unfortunately. But I think, I said in the beginning that if somebody came to today's masterclass for the unique formula, I have to disappoint. And I have to apologize. There is no one unique formula for credit limit granting. Okay, continue. One of my frustrations is getting the customer to respect the credit facility granted and not use it to fund his other suppliers. That's a good question. You see, this is mainly a question to us, first of all. How do we grant credit? Yeah. So let's consider the situation you describe, Misha, because that's important thing. If our client use the funds of financing or our credit facility to finance their purchases from other suppliers, then what in our existing payment terms allow them to do that? Do we give them too long? Normally this happens because we provide too long payment term. For instance, we know on operational side that our operating cycle is 45 days. If we grant them 60 or 90 days payment term, obviously they have another 45 days to finance other businesses or other business lines. But then it's a question why we decided to provide that payment term. Did we consider in detail the factors affecting the payment term? And if we did, this could be the case as well. If we did, what is our trade policy? Do we need such a client? Obviously. Yeah, this could be the case. This could be the case. But then it's our decision. So if we know that our client is abusing or like using our credit facility to pay other suppliers or to purchase something which is more profitable, then it will be a question to us, why do we provide such terms to us as a company? Maybe we are okay with that, maybe not. But first of all, we need to critically consider the terms we provide to our client. Do we give them such a possibility, such an opportunity to use our credit facility in a way you say, to purchase, to finance other business lines? And if so, why we continue with that? It's a question to us, first of all. Then, knowing details, it's a question of sitting with the client and speaking seriously. If we are not happy, then we need to come to them and say, we know 1, 2, 3, 4, 5, we know this or that you are financing your other businesses. And we give you credit facility to do business with us. And then listen to them, what they're going to say. Because it's not them who is taking credit from us. It's our free will. I will insist on that. And I will not get tired to repeating that. We provide credit based on our free will of a creditor. This is our credit, we grant it to them. We can grant it, we cannot grant it. Yeah? And then we need to explain that. Sicily, absolutely that. So this could be overextended terms, but very often, quite often, this happens differently when distributors are taking credit, based on the explanation that they have to provide credit lower on the trade channels. At the same time, on that channels, they sell goods on cash in advance and use that cash to purchase other things. Obviously, they sell on cash in advance with a discount, sometimes with the zero margin, sometimes even with at loss. But they receive cash to purchase something more profitable. This could be the case. There is no one single answer to that situation, but then you need to speak. You need to speak with the client. You need to investigate what is happening, and then build your trade policy. Relationship with if it is individual customer, it's one thing, and build your trade policy and terms and conditions accordingly with other clients. Credit management is complicated. There is no simple solution to everything. Be prepared to that. Nisha, thank you very much for great question. It's really a great question. Thank you very much for sharing. I'm still available for further 10 minutes to answer questions. Okay, one more question. Very good. I find my limitations are with the sales team, customer relations, and relationship with sales, and threatens future sales. That's one of the, if I understand your question correctly and your comment correctly, you see, that's what. Nuhu, thank you very much. Thank you very much for joining us. Yes, I'm very happy to know you like it. You see, unlike banking system, which is generally is in the area, in the situation of exclusive credit. In trade credit, we take decision between two risks, and this will never change. As long as we are in competitive environment, if we grant credit, we take a risk. If we don't grant credit, we also take a risk. That's I have to, I will quote my personal situation, and it was like, moment of breakthrough in my trade credit career, when somehow in the end of the month I was speaking with my CFO, extremely wise person, one of the best managers, best bosses I was working for. And I asked, he asked, is everything okay? I said, yes, everything's okay. I said, sales are asking for lower limits, for higher limits. But I will stand on them, so they will receive it over my dead body. He was extremely wise person, and he said, why? I was nearly disappointed with that question. I said, what does that mean? Why? I am protecting company's assets, being credit controller. I am collecting cash, and you asking me why? Why I'm standing on limits? And then he asked an extremely nice question. He asked me, Andrei, how much money we get from goods on warehouse? Needless to answer. That's like rhetorical question. And then I understood that goods on warehouse do not provide us with any single penny of profit. If you want to have profit, we need to sell. And as we are in a certain commercial or business environment, we have to provide credit. We have to take risk and to sell. And the more we sell, the more profit we get, and the more successful we are. So, Anisha, answering your question, we are always between two fires. In trade credit, we are always between the hammer and the forge. And if you are happy to put your head between the two, that's you are in the right place. Because each time we grant credit, as I said, we take risk. Each time we don't grant credit, we got to risk. We are at risk of losing client, of losing a profitable sale. And we are always, between the two. That's our life. That's what trade credit management is. That's why, by the way, trade credit management is different from the bank. You need to work with sales. We need to find a way to cooperate with them and become, like one team. Because we are doing the same thing. We are just two sides of the same thing. Otherwise, this will never work. Rolando, I like your comment. Thank you very much for that. Relationship is important in business, but cash is the king at the end. That's my favorite topic, so let's speak a little bit about that. You see, let me turn this comment because I think it is symptomatic. And this is again about misconceptions. Everyone in finance is repeatedly saying cash is king, cash is king, cash is king, cash is king. Okay, and as a translation of that, I mean, cash is king, but where the king derives from? That's main question we need to we need to remember, we need to keep in mind. Who is supposed to give cash to a company? Is that investors? Are investors supposed to give us cash, or bankers? They're supposed to give us cash, we put that on bank account, and whether we will have pockets full of cash, whether or not this will be a successful business. I'm very far from that idea. Yeah? Because cash is coming from normal, positive cash. Healthy cash, supposed not to come from finance providers. The cash supposed to come from sales of companies' goods and services. Businesses are becoming successful because they sell their products. They provide something which is useful to others, and they receive the payment. For that. So, and these customers, these consumers, whoever, are paying for that. Then cash is king, but it is coming where? Can we simply get cash without selling something? Yeah? Yes. Simply providing goods, we do provide goods on extended payment terms, and yes, we record that sale, which is not converted into cash yet. But at the same time, will we have any hope for cash if we don't sell? I used to say, and that's what I tried when I'm teaching my fellow credit management colleagues on trainings and everything. I said, I used to say that the famous phrase, a sale is not completed until it is actually paid for, is correct. There is no one single letter in this phrase which is wrong. The only problem with that phrase is that it's only part of the truth. Another part of the truth is that in order to to ask for any cash from a client, we need to sell something to them. We need to provide something useful to exchange. And if we not, we will have no cash. And if there will be no sales, there will be nothing to collect, nothing to calculate, and nothing to use. There is once as a balance to this phrase. Once I've heard another explanation, then if the sales will run the business, there will be no cash. Then if finance will run business, there will be no business. So maybe as a joke, something like that. Okay. Ladies and gentlemen, I really appreciate your patient attention to my humble work. I'm really grateful to everyone who found a minute or a possibility to join us today online. And to every one of you who is watching this masterclass on YouTube, this one is public. So I thank you very much for your passionate attention once again. Please feel free to ask your questions. In the description part of this video there will be links to masterclasses and to courses which you can use if you wish to learn more about trade credit management and about holistic credit management. And as usual, I wish every one of you highest possible sales, lowest possible losses, or, as it could be said in French, bon crédit. See you next time. Have a great whatever you do. Bye bye.